We'll get a start on things. So thank you everyone for coming along today to the next in our webinar series, and really appreciate you all finding the time to come and join us. For those of you who don't know me, my name is Ashley Shield. I'm an Executive Director at de Jong Reid and based out of our Melbourne office. So you're enjoying videos from our bedroom, given our state of affairs down here. And today I've got joining us, as we did last time, Phil Homenko, who is our compliance manager running out of our Brisbane office. So you can see that he has plenty of sunlight because he's allowed out for more than an hour a day to get some sun. But today, Phil and I are going to be talking about security interests registered over companies. We will have a look at the security interests are and how they work. The banks take security for a reason, so that they can get paid get paid as a creditor before the others that are unsecured. Security interest can put them in a stronger position, enable them to take action to protect their interests. Unfortunately, we see cases where directors or related entities that have lent money to the company, like a bank, but they're doing it totally unsecured. Why? They have the same rights as a bank to secure their loans, but these often get overlooked. So today we're going to have a look at how to take an appropriate security interest can help protect your client's position. And before we get into the meat of the conversation, I just wanted to cover off on a few things in the recent events in our ever-changing COVID world. The first of which, for some of you may or may not have heard, that the federal government has extended, probably a little bit surprisingly, has extended the insolvency protection regulations that were initially put in place in March, which means that directors of companies cannot be liable for insolvent trading during this pandemic period up until the 31st of December. They've extended the regulation to. They've also, as part of that package, they've extended the regulation around creditor stat demands and bankruptcy notices. And if you may remember, they provide now that if you issue a creditor stat demand or a bankruptcy notice, the recipient has 6 months to respond, not the normal 21 days. And the amounts of those have both been extended to $20,000 from 5 and 2 respectively. So that's an extension for another. It was due to expire on the 25th of September. There is a bit of media and press out there, some saying that it's a bad idea, some saying it's a good idea. From our perspective, we believe that extra protection does give our clients and your clients time, which is what the Treasurer mentioned at the time, was it was to give businesses time to restructure and to effectively turn around their businesses before people can start chasing them. So it does give them some extra protection, so it's a wise idea to use that time. For those of us in Victoria, the Victorian government has also extended the rental protection through to the 31st of March. So landlords have lost a little bit of power in their ability to kick people out of their properties or to take over properties again. So those protections are in place through the 31st of March. But effectively, that's the only state that we're aware of at this stage that has extended those measures. The other one that I wanted to mention is that the ATO came out earlier this week saying that they will start soft collection of their debts this month. They have made it clear, however, that they're not going to start doing any calls in Victoria. But for the rest of the country, they've made it clear that they are going to start collection action. Because of the insolvency rules, they're not going to be able to do the hard stuff of liquidating companies and things like that for a while. But they're, in the words of the ATO, they're going to engage with those people who have a tax debt to try and get some payments made. So some debt collection activity will start to occur. So, but as I say, at the moment, it's Victoria has been excluded. So if your client is say for instance, they've got all of their details registered with the accountant and the accountant is based in Queensland or New South Wales. Please remember that by telling the ATO that the client is Victorian based, they will leave you alone and give you some more grace period. So they're just a couple of the little updates that I wanted to give. So I'll now hand over to Phil and we can get started on the main part of the presentation.
Thanks, Ashley. Here we go again, mate.
Right, that's what we do.
That's it. So let's just kick off with some basics. What would you say the most common types of security interests are that you and I would see in our day-to-day work?
So the predominant two, Phil, are what they call an all-PAP, which is an all-present and after-acquired property registration or charge, and the other one is what they call a PIMSI, which is a purchase money security interest.
So we love our acronyms, don't we? So all PAPs and PIMSIs. Let's do it backwards, and we'll talk about purchase money security interest or PIMSIs first. Could you explain to everybody, what does it mean? What is a PIMSI and what does it do?
A PIMSI security is a charge over a specific asset, like stock or a piece of equipment. It has a super priority to other creditors in relation to that specific asset that is subject to the charge. It doesn't give priority for it. It gives no priority for payment for other assets or of the company aside from the asset that it's actually registered for.
Right. Any rules or deadlines about registering a PIMSI?
Any legislation comes with rules and comes with dates. There are very strict timeframes when it comes to PIMSIs, and they vary depending on the type of asset that you're securing. So if you're securing inventory, for instance, the registration must be, the PIMSI registration must be registered prior to receiving of any of that inventory items.
Right.
So you need to enter into the agreement, have the registration approved before there's any goods have been passed between the two customers. For all others, they need to register within 15 days of taking possession of the property. So if you're buying a car, for instance, or selling a car, the registration needs to be on within 15 days of the delivery of the vehicle.
Okay, so that is pretty strict. Who would commonly take a PIMSI? What sort of person or company would do it?
I'd actually like a lot more people to take it than do, but predominantly, if you're supplying goods, if you're a trade supplier, then you take a PIMSI over the stock that you're providing to other people. Asset financiers obviously will do it for any of their equipment that they're put under a shadow mortgage or any of those type of things. And then debtor financiers are the other big one that use it for securing the debtor book.
So it's pretty common. Just about every trade creditor out there has the right to do it, and all the asset financiers can do it as well. So there's a lot of it.
Look, I think I'd be careful, Phil, and probably a bit more of a banter with you, but it's not as common as we would like. Yeah. So the bigger companies are certainly using it. The smaller companies are the ones that I think have completely missed the boat on it.
Yeah, good point. So we say that people take these things for a reason. What sort of rights does the person that holds a PIMSI have? What can they do?
So a PIMSI holder will have the ability, if they're not being paid for whatever, they have the right to come in and take possession of their goods and get their assets back. Whether it be a vehicle or if it's stock, they can come in and take their stock back. But one of the other things that this new, and I say new, but it's now nearly 8 years old, or over 8 years old, is that you have a right to take the cash from the sale of that. So you've got more power than you did just over the goods in the past. So you have access to the cash that's been sold in relation to those goods.
Mm. Now, you said earlier that the person that holds a PIMSI has a super priority. Sounds pretty impressive, a super priority. What does that actually mean?
Well, in simple terms, effectively what it means is that if they have a priority over any other creditor as it relates to that particular asset. So, a company could have hundreds of creditors, but if the PIMSI holder, if that asset is sold, let's call it a motor vehicle, for instance, if that's sold, they have the absolute right to get their money first.
Right.
One of the interesting and one of the benefits of the PIMSI is that someone who's got the asset can't pass clear title without dealing with the PIMSI holder. If you're selling a car again, you can't sell it to someone without giving clear title unless the PIMSI holder has been satisfied and they remove their charge.
Well, that does sound pretty powerful. So what about an all-PAP, all present and after acquired property? Could you break down for us what that means in basic terms, Ash?
Pretty much what the title of it is what it is it is all current and after acquired property. So it secures everything that the company owns that doesn't have a PIMSI charge on it. And it also secures everything that the company might buy after they've actually initially done it. So if the charge is put on in January and then you get a new asset in July, it still has the ability to attach to those newer assets.
All right.
But it does, I think that one of the key things is it does rank behind it only as it relates to that PIMSI.
So rank behind the PIMSI insofar as it pertains to that asset. And then if there's anything left over, it secures that asset after the PIMSI's been dealt with.
That's correct.
Right?
Yep.
Okay. You know, I'm pretty old, and the camera doesn't lie. These are grey hairs.
No, mate, you and I, you're not short on grey.
So in the old days, we used to talk about these things as being fixed and floating charges. So under the new what I call the new regime, in the old days, we'd call them fixed and floating charges. So what are the rules about registering an all-PAP? As you said earlier, there's rules about everything. Tell us what the rules are for this one.
Yeah, so with an all-PAP, you need to have the registration. And I think something that we should talk about, Phil, is just the clarity between the charge and the registration. So whether it be a PIMSI or whether it be a all-PAP, what the loan documents or the contract documents are the ones that actually create the charge. So if you enter an agreement to supply stock, there's the charge is granted in those documents. But under this PPS regime, it's actually the importance actually comes with a notification of the charge, which is the registering of the charge on the security register, which is administered by the Australian Financial Services Authority. So, and it's a public notice board that everyone can go and have a look at. If you're looking to buy a car, you can type in the VIN number and see if anyone's got a registration against that vehicle to ensure that you get clear title.
So I could have the agreements all correct, but if I don't register the charge, it's not effective.
Completely irrelevant. Yep. It has no power. So the notification or the letting the world know that you have that right to the charge by showing it on the register is actually the critical thing here. Not necessarily the documents on its own. So with an all-PAP, it needs to be registered within 20 days of the first advance or the loan being granted. So you have 20 business days, caught me this morning, the 20 business days to register the charge has to be from the loan granting. If it's not registered within the 20 business days, then and you register it on the 21st, then it still can be registered, but it can be called what we call a green charge. So it won't necessarily hold up for a period of 6 months. And if the company becomes insolvent within that 6 months, it is automatically voidable as not being a valid charge.
Right. So if I don't register within 20 business days and the company goes into has an event of insolvency, within 6 months, that charge is gone. That charge is voidable. Yeah, so if I last the 6 months, Ash, I register it today. It's an old loan. I didn't do it within 20 business days. If I last the 6 months, everything's okay, yeah?
Yeah, you'd think the law would be simple that way, but no. No, it's a lot more complicated than that because it can still be voidable by the Corporations Act because it hasn't been registered within the right timeframes to start with. So the Corporation Act does have some impact on that. A liquidator can deem the transaction to be uncommercial if certain circumstances meet, or it could be that it's deemed preferential because it's been put in after the loan was advanced and it's been provided as a security that wasn't initially available to it, giving it a preferential treatment from others. So it is something that you need to be very mindful of to get right.
Mm-hmm.
And if you have ones in the past, or if you have ones that are wrong, then getting the right legal advice about how to manage that is imperative. And we're not going to pretend here today for everyone that we are lawyers. So there is very specific legal rules around it. And we, as a firm, we will, we're obviously giving you an idea of it here. If it's a specific issue that you want to talk about, we often do get lawyers involved to make sure that we protect the position of the client.
So as you said earlier, Ash, banks and lenders, they take these charges all the time. And I know from my work here at De Jong Reed, I see PIMSs and all PAPs on virtually every corporate job that I do. There's some sort of security registered there.
Yep.
But so why don't directors or related parties take these security interests themselves?
Look, probably a couple of reasons that I would see mainly that happens. One is that they actually don't think they have the right to, or they haven't even been told about it. It's not something that they see as something that happens. And if I lend my brother some money, I don't necessarily think that I need to take security out against my brother.
Yeah.
So I think when it's your own company, you're in control of the company. You think that you can pay it back whenever you want. And all is good in the world. But unfortunately, it's when these insolvency events occur that the all good in the world isn't quite so good anymore. So I find most of the time it's just purely a combination of ignorance and not thinking that they actually have the right to, because it is a related party.
So they can take these interests out. What about their bank or their lender? Will their bank be upset if they register a security interest against their company?
Well, no. I mean, the short answer is banks, anyone who lends money to the company has a right to put a charge on. So the only thing when it comes to banks is that, like any financier, they're going to want to try and get the highest level of security and priority they can. So some of the people here today would have heard me recommend that when you start up any new business, get the director to lend $100 to it on day one, so that you can put a security in straight away, so that you're the top-ranking secured creditor. But if you then go and borrow money from the bank, they're going to ask for priority. So as long as they get that priority over your charge, they're not going to have a problem with it. I mean, and banks know that everyone puts a security in place. They will want to rank above you or the director to if they are lending money. So if you give them that, they're not going to have a problem with it.
So as long as the bank's got the priority that it wants, they're really not going to care whether a related party puts an all-PAP security interest on that company.
No, they certainly no problem. And I know, like debtor financiers, they need to talk to the bank. If there is a term loan in place for the bank and a debtor financier comes in, then the bank will often need to give a release of the debtors under their charge to give that priority under a PIMSy to the debtor financiers. So the banks are used to this more than anyone, and know how to play it for their advantage and fit within the rules.
Geez, that's a surprise. There's no reason that directors or related parties can't take security interest for the loans that they grant to the company.
No.
What are some of the things they should look at when they're going to do that? How should they go about it, or what matters should they take into consideration?
Yeah, well, the first thing is obviously get the right advice from the right person is the critical thing, to make sure that you're getting the right documents and doing the right type of charge for whatever the transaction may be. They need to enter into a loan agreement, and that loan agreement can have or not have an interest rate. And again, that's a conversation all of its own, because if a director lends money to the company, the loan agreement has an interest rate, then the director needs to receive interest, which becomes an income at the personal level. So they need to talk to their accountants the accountants and advisors about how they want to do that. The loan agreement should have events of default and repayment plans and stuff in place. Now, that can be a repayment on call, or it can be a schedule of payments. It doesn't matter, but that needs to be planned early as well. And the documents need to give the right to offer security. So it needs to be documented that they have the right to take the security position.
And then, as you said earlier, that they've got the right to do it, and what we can assist with is help their professional advisors work through some of those issues.
Yep.
Now, I think with this, there's a lot of specialisation in all professions now, accounting, the legal industry, and there may be some solicitors that are not expert at these matters, and others that are all over it. So, I think it's a matter of getting advice from someone that's really in that field and can really add value to what the client's trying to do. So coming back to directors and related parties, they can charge interest on their loans subject to accounting and tax advice. Now, that makes sense to me because banks certainly do it. Now, what I'd like to do now, Ash, is move on and talk about how that security affects things in the real world.
Yep.
Now, you said earlier that a PIMSI has a super priority over the asset to which it attaches. They get paid out first. And that seems pretty clear to me. But let's say they've got a security interest over a specific asset and they get paid out. What if there's some money left over? So vehicle's worth $60,000. The asset finance on it's worth $30,000. What happens to the leftover money?
Well, obviously the simple term is the rest of it goes into the company or whatever the structure is, and then it is then subject to whatever other security is in place. So if there was an ORPAP in place, then the rest of that money falls under the control of that ORPAP, and then flows through that way if need be.
Now, as you said earlier, they've got priority to the asset to which it attaches. So in that example I gave, if I flipped it around and said the car's worth $30,000 and the finance on it is $60,000, the lender would get the first 30 grand and then they'd be unsecured for the other 30,000 they're owed. Is that correct? That's the way it works?
Once their security, if they give up their security to take that 30,000, then yes, they become unsecured for the rest.
They become unsecured for the rest. Okay, so that seems pretty clear with PIMSIs. Tell us a little bit about ORPAPs. How do they work in an insolvency situation?
That's a whole lot more complicated.
Or it is.
I know we've got some liquidators in here who would have all sorts of fun looking at the process and the order for this. But in really simple terms, at a high level anyway, an ORPAP will always get paid in their order of registration. So going back to my previous comment, I always think it's exciting to have the director having the first ORPAP, because then in a bad event, they sit high ranking, subject to priority. But if you've got two ORPAPs in place, then the first registered one has the right to get paid first, and then it tiers down from there. The ORPAP, though, has two components within it. I think for some of us with the grey hair like you and I, we would remember the fixed and floating charge, and there's very much a separation in an ORPAP of the fixed and floating components. So in the charge over the fixed assets, and there's a charge, the floating part now is called a circulating asset under the new regime. So the proceeds from sale of fixed assets goes to the ORPAP providers as a priority and gets paid first. But proceeds from the sale of the realisation of circulating assets actually goes to a priority of the employee first. Then if the employees are paid out, then the rest will fall back to the ORPAP provider.
Right.
After that, you then get into the unsecured creditors. And what we're finding, unfortunately, is that most directors and related parties leave themselves in an unsecured position.
And even though often they're owed more money than the bank is, the bank's secured and they're not. Well, you were right, Ashley. That did sound pretty complicated, the way that all works. So what we'd like to do now is just work through a bit of an example of that and just show everyone how it actually does play out. So I'll grab our trusty whiteboard.
So while Phil's getting set, a lot of you would have seen that there's people with really fancy whiteboards that link into the system. We just love using the old standing whiteboard.
That's
So,
Okay. In this example, we're looking at a company. The company's got some assets that are available. It's got trade debtors of 250. It's got some plant and equipment that's under finance worth 120. It's got some plant and equipment that's unencumbered. Now, here's its debts down here. It's got an overdraft to its bank that's secured by an ORPAP. It's got some asset finance to its bank that's secured by a PIMSI. A related party, Anne, the director of the company, has lent the company 350,000. So as you can see, she's actually lent a lot more money to this company than the bank has. There are trade creditors that are owed 250,000. The ATOs owed 300, and there are employee entitlements worth $50,000. So the total debts of the company are 1.15 million. Now, the company's got $570,000 that it's available to distribute to meet its obligations. So we're going to look through a couple of examples of this. And I could plug this in, but we'll just slide it across. We'll just slide it across instead, actually old-fashioned way, mate. So in this example, this first example that we're looking at, Anne does not have security. Anne's like most directors out there. She's lent the company a lot of money, but she hasn't taken a security interest and she's totally unsecured. So I've got $570,000 to meet its debts. Let's talk about where that money goes and in what priority. The first person that gets paid is the PIMSI holder. So the person that's got the charge over the specific asset, they're entitled to the proceeds from that sale of that asset under their super priority, and they get paid first. So that's where 120,000 goes. Then the bank is entitled to be paid out from the fixed assets of the company under their ORPAP, under the fixed component of their ORPAP. And in this example, the only other debt they had was the $80,000 overdraft, and there's sufficient fixed assets there to pay that out in full. So now the security interests have been satisfied. Next in line now are the employees for employee entitlements, and those employee entitlements are $50,000. Now out of this, we've now distributed 250,000 out of the 570 that was available, which leaves us $320,000 left over. Now, if this company was to go into liquidation, the liquidator is entitled to collect their fair and reasonable professional fees for doing all the work that they have to do to investigate the affairs of the company and to go through their process. And in this example, we've said the liquidator is going to charge about $30,000 for that. It may be more, it may be less, but in our example, it's 30 grand. Now that leaves the company with 290,000 that's left available to pay the remaining unsecured creditors of that business. So that money is then paid out proportionately to all creditors, depending on how much they are owed. So in our example here, Anne was a pretty significant unsecured creditor. So out of that $290,000, her proportional share is $113,000. So as you can see in this example, the bank lent a total of $200,000 between an overdraft and an asset finance facility, and it gets every single cent back because it had a secured position. Anne, on the other hand, lent the company $350,000, but because she's unsecured, she's now in line to only get $113,000 back. So now let's look at exactly the same situation, but in this next scenario, Anne has a valid security interest. She's taken an all-PAP charge over the company. So now let's have a look at how that affects the distribution of the monies that the company has available to satisfy creditors. Here we go. So I've still got 570,000 to dish out. Again, PIMSI, super priority over the asset to which it attaches. There goes 120. The bank is then entitled as the first ranking creditor because they were registered before Anne. So they get their $80,000 back for their overdraft from the fixed component of those assets. Anne is then the next ranking all-PAP holder. So she has priority for any proceeds from the sale of other fixed assets. Now in our example, after the bank took their 80,000 here, there was 120,000 left in sales proceeds from other fixed assets, and Anne now has priority to receive that 120,000. So that's all of the fixed assets dealt with. That's the PIMSI holder satisfied, all the plant and equipment sold, and that fixed money, that money that came from the sale of fixed assets has now all been allocated. So what we've got left now are the circulating assets of that business. They are captured by Anne's all-PAP interest, but because the money's coming from circulating assets, employee entitlements now have priority to be paid fourth. So those employee entitlements are $50,000. Once they've been paid, Anne's all-PAP resumes its priority from the proceeds of the circulating assets, and she can collect another 200,000. Now this money came from debtors. We had 250 in debtors. So 50 from the circulating asset being the debtor goes to the employees. Then the all-PAP holder gets the rest of it. There's your 200,000 goes back out to Anne. So now we've still distributed our $570,000 and all according to priority and security positions. So what does this really mean? If Anne was unsecured, she'd be in line to receive $113,000. If Anne had secured her interest, she'd be entitled to receive $320,000. So that's a massive difference when you look at it from Anne's perspective as to having a security interest in place for that loan or not having a security interest in place for that loan. Now, the whole cost of putting that security in place is likely to be sort of $1,500 to $2,000, there or thereabouts. And it just makes a massive difference. So here she's losing 237,000 is her loss. She's out of pocket 237 grand. If she had taken a security interest, she'd be out of pocket $30,000 and entitled to be paid in priority to all other unsecured creditors. So that's just shows you what it can mean in the real world if the difference with a related party having security as opposed to not having security. Now, I know that can be a lot to take in, and I ran through that in about 5 minutes or something. It is a complex area. It can take you a bit of time to get your head around it. So Ashley and I'd make the offer now. If you'd like to discuss this matter further or delve into it a bit deeper, feel free to give one of our team a ring or to give Ashley or myself a call, and we're more than happy to go through it with you again, because we understand it's a lot to take in a short period of time. Now, Ashley, I'd imagine right now with the situation with COVID and businesses out there, that there'd be a lot of directors or related parties that are now probably in a position where they're considering or they may be required to make new loans to their company to keep them going. Would you agree that that's going to happen?
Yeah, mate, I think that we're going to see that. And I think the interesting thing for me, though, is that there's not a director out there who go, I'm going to lend my company money. What in their mind, and I think it's important to understand that these guys, I'm going to put some cash in to prop it up. It's almost a non-thought. It's, their business owners are optimistic by nature, so we need to keep the business alive. I've got 50 grand sitting in my personal account, so I'll throw it in there because that's what I need to do. If we could actually even get them to consider that they're lending the company money, that would be a good start. But but it's there's certainly we're already in discussions with a number of people who are wanting to prop their business up until it gets up and running again.
It was a long time ago, and people might not believe this, but once upon a time I was a Boy Scout, and we used to have this little thing about being prepared. And a lot of that is sort of hoping for the best, but preparing for the worst.
That's it.
But taking security doesn't mean that the director, doesn't believe he's going to get paid back. It's really just like having a bit of an insurance policy if something unforeseen happens, that you're putting yourself, you're making all the preparations that you need to make to protect yourself and your family if something doesn't work out the way you want it to.
Absolutely. Yeah. It's important that that's looked at now. Yeah. And
Absolutely. I'd say that anyone that's considering making a new loan to their company to help it through this COVID period really needs to take the steps necessary to get a valid security interest registered as soon as possible, and certainly within the timeframes we spoke about.
And even if we, and as I said before, do it for $1 if you have to,
Yeah.
and then wait for more. If you end up putting more money in later, at least have the security registered.
Absolutely. Now, banks put security interests in place for overdraft limits. They might not be owed anywhere near the limit at the time, but they take the security now in case the debt goes up later. So
That's it. Yep.
similar sort of thing. All right, Ash, so maybe now's a good time to have a bit of a talk about the elephant in the room.
Oh, yeah.
And what I want to talk about now is all those related party loans that are out there right now that all of our guests today would have clients probably that have those types of loans, and there's no security in place for them right now.
Yep.
What should they do? What sort of things should they think about or consider?
So ideally, we want to get them secured, but that's obviously a very complex area and very tricky to deal with, given that they've passed the 20 business days. So trying to put security in place for something that wasn't secured is a lot more complex than doing it from the start. But it is important that we look at that and try and put something in place now. So again, these are only relevant if we go into insolvency.
Yeah.
So putting a protection in place today that may not be needed for 3 or 5 years is a good insurance policy to have. Obviously, there are shorter term issues that come into play now with the risks that some businesses have. But finding a way, depending on the transaction, of actually getting these things secured now is very important.
Now, as you and I have said a few times, and it's like we're almost proud of it, we're not solicitors. Right? We're not lawyers. So, and we always, at De Jong Reed, we always recommend that our clients seek independent legal advice, right? And they make their own investigation and get the advice from the professional that knows about it. But subject to legal advice, are there any circumstances, or could you give me a circumstance where a director could register a valid security interest for an older loan?
Yeah, look, there are, again, it is very transaction specific, or how you create the transaction. But look, one of the big things that we will always look at doing is whether we can structure a transaction to repay the loan and then enter into a new agreement. Again, it's tricky in how it's done. The other thing is that if you are lending further money, that part of the negotiations of lending that further money to the company is around the negotiations of actually structuring a security for all of the debt. So, if you've already got 150 in the pot, you know that you need to put another 50 in, that there is a negotiation where the director is negotiating with the company to give it extra money, but we'll only give you that extra money if we're provided with a certain level of security. So there are a couple of the ways that we look at trying to structure transactions to give that. We're mindful that it has its issues, particularly if you did it and then the week later you went into liquidation. It can be perceived as an uncommercial, avoidable transaction. But it's those are the type of ways that we can look at trying to secure things that weren't secure before.
So the argument to go along the lines, the company needs the money, it can't get the money anywhere else.
Yep.
And it wants more money from the director, and the director says, well, if you want this money, I want all of my debts secure. Therefore, there's something in it for the company. There's a benefit from the company. So it's not uncommercial. But we'll say again that it is a complex area, and directors and related parties should seek their own independent legal advice. But we certainly strongly believe that it's well worth exploring what options there may be to perfect a security interest to secure whatever debts the company is owed.
And I think that the thing I want to be clear about is that if you do this the week before you go into liquidation, there's very little you're going to do to secure an unsecured debt and make it better. So these are about long-term strategies, not I've got a business that's going to fall over tomorrow. How do I turn an unsecured debt into a secured debt? That's not what this is about, and that's not what it doesn't work that way.
No, all we're about is advice, and informing our clients that there may be legal options available to do it the right way and make it valid, and making sure that they talk to a person that specialises in that area or is knowledgeable and can give them the legal and accounting advice that they need to make an informed decision.
That's correct.
So what's the best advice that you could give somebody about related party loans, Ash?
Document it.
Document it. Yeah.
Well, the primary thing is truly to document the amount of the undocumented loans that we see that they're in place is unfortunately way too high. So get the loan agreements documented. If it's a new one, secure your interest immediately. Get that done right up front. If it's an older loans, then it's more about you can talk to us. We'll then look at structuring something and getting the right legal professions involved in making sure that it's set up properly to get the best valid one. But look, a loan agreement does so much if you've actually got one when you first document a lending of money. And I think that's what I was trying to say before, is that most of our clients as directors don't even consider it a loan. They're just doing what they have to do to keep their business alive. So, getting people to understand that it is a loan, that they have rights, and that they should secure those rights.
Great. So look, let's just do a quick recap. Today we've spoken about purchase money security interests, PMSIs. They're over specific assets. They can be physical assets like motor vehicles or plant and equipment. They can be intangible assets or circular things like debtor books or intellectual property or things of that nature. They have a super priority for payment, and they're first in line to get paid from the proceeds of the sale of whatever asset that charge specifically relates to. We've spoken about all PAPs, which are all present and after acquired property, and how they rank. Directors and related parties can take these security interests. The banks aren't going to get upset. Crucial step is to document the loan agreements and register the security interests within the prescribed timeframes, if at all possible, but then to explore the options and seek the appropriate advice for securing existing debt that's owed to related parties. And as we've seen through our example, they can have a massive impact on the outcome for directors and related parties should the company have an event of insolvency, because in that situation, monies must always be paid out according to priority and security positions. And if you're secured, you stand a much better chance of recovering your money than if you're unsecured. And unfortunately, in my day-to-day life, the majority of director and related party loans that I see are completely unsecured, and they rank right down the bottom behind everybody else, irrespective of how much money's owed.
Yeah.
So Ash, that's pretty much what I had for today, mate.
Yeah, and I think it's interesting, Phil, that we I know that through over the years of meeting with many clients in distress, one of the first things they always say to me is that I put all this money in, why can't I take some of it out?
Yeah.
And that unfortunately is they can if they're secured. If they're not secured, then that's obviously creates massive issues. So we will, to everyone now, open up for any questions that anyone may have. You can do that via the text box, by the chat box that I think after 6 months of us all being in this semi-isolation phase, you probably all know where that is now, or you can use the function that says raise your hand or unmute yourself and just yell out. So more than happy to take any questions that anyone may have. You all unmute, so turn your cameras on so we can all see you as well. It's a good fun afternoon. Oh, there's Kate.
Hey, Kate.
A few people. So one of the questions that we had earlier in our session earlier this morning was that people talked about the PMSIs being a physical asset security versus the all-PAP being everything else. And I think it's important to note that PMSIs isn't necessarily just physical assets. It's anything that you can specifically put a charge on. So it could be debtors, it could be IP, it could be any of those sort of softer assets, as well as the hard assets as well. So any of those, just the PIMSI is all about a specific asset, not necessarily a physical asset. No questions there coming from anyone. Don't be shy. It's a very complex area. The other, while everyone's thinking of questions, the other one that came up this morning was around whether you secure against an ABN or an ACN, particularly in a company trust structure. So in that company trust structure, it's actually, we actually have it is a whole presentation on its own. It's a very complex area. And for those who do want some further training in it, we do actually have a training session on that specific thing. But in a very high level, what you really need to look at is that the registration should be, so it's clear for anyone who's looking that the registration is there. So for instance, an example where you had a trust that was the operating entity, the business was run clearly through an operating trust, but it had an ACN. If a charge is put on the ACN of the trustee company, but the trust is the one that's operating, it could be seen as that you're not putting the charge in the right spot for everyone to see. So it should be on the ABN in that case. So it's very complex, and I don't think Phil and I could have said it enough today that in any particular registration, like we as a firm, we can give you some advice around what you should be putting charges on, what you shouldn't. But we always refer the work out to a solicitor to actually have the charges put on. We don't actually do it ourselves because it is a very complex area that needs to be done with the absolute due care and diligence.
And I just add to that, Ashley, that major banks and lenders that do this all the time, they get it wrong too. And there's been plenty of examples where they've registered over the wrong ABN or ACN, and some of the losses they've incurred through getting that wrong are absolutely mind-boggling. You know, the dollars involved.
Yeah, well, as you know, there was a case with All Steel. It was like $100 million asset that they put it on the ABN instead of the ACN, or ACN instead of the ABN, and they lost the asset. So yeah, there's some big numbers that have got lost. So looks like we've answered everyone with everything that they need to know. So no questions coming up. So if that's the note, I will just let everyone know that on the 8th of October, you'll receive an invite shortly. We is the next in our series, and we actually have a special guest coming in to speak at that one, so you won't have to listen to Phil and I quite as much this time. So hopefully that'll be very enjoyable for you. I wish everyone all the best over the next month as we move through the next phase of our COVID relief, and particularly as some of the stimulus packages come off and the impact that that'll have on your clients. I think we've got about a month to go before most of the stimulus packages will come off, unless you're Victorian based, and then we don't actually know. I do know that a lot of you are actually working with clients now to put themselves into the stimulus packages while others are coming out. So I do know it's a very complex period and tough period. So I wish you all the best for the next month. Look forward to catching up with you then. Thank you all for coming along. And please remember, if you've got any questions, any concerns about a client, or just want to get some clarification on this or any other issue related to people in distress, please pick up the phone to either myself or any of the team that we have Australia-wide that are ready to look after you. So thank you all, and have a wonderful day.
Thanks, everyone.